Welcome to today's Explainer. As investment analysts, we're constantly looking for discrepancies between what the market sees and what's actually happening under the hood. So today, we are going to tear down the financials of Itaú Unibanco, the largest private bank in Latin America, trading under the ticker ITUB. Now, on the surface, this bank looks like the ultimate emerging market dream, right? We're talking about an elite 21% return on equity and a juicy 4% dividend yield. But when we put on our analyst hats and look just a little bit closer, a massive contradiction appears. That incredible return on equity is hiding a return on invested capital of just 1.5%. So the big question we need to answer today, is Itaú a brilliant buy trading near its 52-week high, or is it a value trap just waiting to spring?
Okay, here's our game plan for today. We'll start with the value paradox, then uncover the red flags and hidden risks before flipping over to the green flags and elite strengths. Then we'll put this stock through the Guru gauntlet and wrap up with our final verdict.
All right, part one, the value paradox. Talk about massive cognitive dissonance. If you're a serious investor looking at these metrics, your head is probably spinning. On paper, the numbers are elite. A 21.5% return on equity, a top-tier 32.6% net margin, a totally reasonable 10.4 PE ratio, and that solid 4% dividend yield. But beneath that shiny surface is a really dark hidden reality. We're looking at a disastrous 1.5% return on invested capital and an effective gross margin of 0. So how is that even mathematically possible? Well, the answer is a 488% debt-to-equity ratio. The bank is using massive leverage to pump up its ROE, while the actual return on the capital invested in the business is practically non-existent.
Now, you might be wondering, why on earth do investors tolerate that kind of leverage? Well, one single number explains it all. 92 million. That is Itaú's staggering customer base. To put that into perspective, they are banking for nearly half of Brazil's entire population. From retail and corporate banking to asset management and insurance, the sheer scale of this operation is absolutely massive.
Moving right along to part two, red flags and hidden risks.
Let's apply the Warren Buffett lens here for a second. Buffett famously says that the single best proxy for moat strength is ROIC consistently above 15%. Itaú is sitting between 1.5% and 3%. I mean, that is literally 5 to 10 times lower than Buffett's required threshold. In his framework, that is a catastrophic failure. Combine that with a 0% gross margin, which, is partly a quirk of bank accounting, but it still highlights a deep structural reality, and it tells us that Itaú lacks true pricing power. They're price takers, folks, not price makers. And when we look under the hood at the quantitative data, the warning lights are definitely flashing red. Guru Focus calculates a GF value of just $5.82, which means the current price is significantly overvalued. Plus, growth is visibly slowing down, with 2026 revenue projected at just 5.1% and EPS at 9.6%. We already touched on that insane 488% leverage, which will absolutely amplify losses in any economic downturn. And we can't ignore the recent Q2 EPS mess. But honestly, the most concerning red flag for a $95 billion company might be the insider ownership. It sits at a tiny fraction of 1%. Management has virtually zero skin in the game. Then we have to look at the macro environment. Remaining perfectly objective here, it is a fact that Brazil is heading into a presidential election in October 2026. Even Itaú's own CEO has publicly stated that this election, combined with Brazil's fiscal situation, is going to crank up market volatility. When political risk runs this hot, future earnings predictability essentially goes out the window. Okay, let's flip the script and look at the case for the defense in Part 3, Green Flags and Elite Strengths. Despite those abysmal ROIC numbers, Guru Focus actually hands the stock a 7 out of 10 wide moat score. Why? Because their market dominance is undeniable. Those 92 million customers create an incredible network effect. Plus, think about the switching costs. Nobody likes the nightmare of changing their primary bank, right? They also boast top-tier brand strength in Brazil, and banking naturally comes with massive regulatory barriers that keep new challengers out. They've also been heavily investing in their digital transformation to fend off nimble fintech startups. And Wall Street is definitely buying into this dominance. Analysts are highly optimistic, largely maintaining a consensus buy rating. With the current price sitting at $8.18, the average target of $8.84 implies a solid 8 to 16% upside. JP Morgan is even more bullish, setting a high target of exactly $10. Furthermore, this company offers a fantastic defensive playbook that income investors absolutely love. That 4% dividend yield? It's actually paid out monthly. They also generate a mountain of free cash flow, 125.3 billion reais to be exact, giving them a free cash flow yield well above 5%. Management is actively returning value by shrinking the share count by 2.65% over the past year. Short interest is practically non-existent at 0.24%, so the market isn't betting against them. And finally, they have a uniquely low beta of just 0.16. That acts like a giant shock absorber, making the stock significantly less volatile than the broader market.
Now for the really fun stuff. Part 4, the Guru Gauntlet. As expert analysts, we need to synthesize all this conflicting data. So, what happens when we put Itaú Unibanco in the ring with the rigorous investing frameworks of Benjamin Graham, Peter Lynch, and Warren Buffett? Let's find out. First up, the father of value investing himself, Benjamin Graham. Running his defensive investor checklist, the verdict is definitively mixed. The PE of 10.4 easily passes his test of being under 15. But almost everything else fails. The price to book is too high at 2.13. The current ratio is a dismal 0.35, and that massive 488% leverage completely shatters his debt-to-equity rule. Most importantly, when we calculate Graham's intrinsic value formula, we get a Graham number of $7.15. Trading today at $8.18, the stock is sitting at a 14% premium. For Graham, there is literally zero margin of safety here. This would be a clear pass at the current price. Next, we bring in the growth at a reasonable price legend Peter Lynch. Evaluating this through the Lynch lens, he would probably issue a C grade. His primary metric is the PEG ratio. He wants to see the PE perfectly match the growth rate, giving a PEG under 1. But Itaú's PEG is sitting anywhere from 1.46 to 2.52. With EPS growth slowing to 9.6% and revenue growth lagging at 5.1%, Lynch would categorize this as a stalwart that's just priced a bit too high for its current trajectory. His likely opinion? Hold off and wait for growth to accelerate or the price to drop before buying. And finally, let's circle back to Warren Buffett's full scorecard. Honestly, this is a hard fail. Yes, he absolutely loves that 21% return on equity, but that catastrophic 1.5% ROIC and 0% gross margin reveal a business heavily reliant on leverage rather than a true economic moat. Throw in the unpredictable political environment that makes forecasting future owner earnings hazy at best, and this is an easy sell or pass for the Oracle of Omaha. So, the real synthesis from our Guru Gauntlet. It all comes down to the great moat debate. Itaú undeniably possesses a massive market share moat, but they have absolutely no pricing moat. They operate in a commodity business, which is exactly why their gross margins sit at 0. They are brilliant operators in Latin America, but they lack the fundamental pricing power that the true investing greats demand.
Which brings us to part 5, the final verdict.
If you are seriously considering this stock, you absolutely must track this timeline. First, September 2nd is the ex-dividend date, a crucial cutoff if you're chasing that monthly 4% yield. Then, October brings the highly volatile Brazilian presidential elections. That is a major catalyst that could swing the stock wildly, depending on the market's read on fiscal policy. And right on the heels of that, on November 3rd, they'll report Q3 earnings, giving us a clear look at how they're actually navigating these headwinds. Look, Itaú is undeniably one of the most well-run banks in Latin America, but our final analyst synthesis is clear. At current prices near its 52-week high, it fails the strict frameworks of Graham, Lynch, and Buffett. The leverage is sky-high, the political risk is very real, and the margin of safety simply isn't there today. So I'll leave you with this final thought to ponder. Is a dominant Latin American bank worth your hard-earned capital if it turns out to be a terrible Buffett stock? Make sure to do your own homework and dig into those 10Ks. Thanks for joining me on this explainer, and keep learning.